This is the oldest debate in personal finance, the American dream of owning a home versus the Wall Street dream of owning a piece of a world-class company. In this video, I'm going to tell you why conventional logic about investing in stocks versus real estate is wrong, and then we'll walk through the data on what actually is the better investment based on history and also you and your risk and investment profile as an individual. And to wrap it up, we'll run the real numbers in a 20-year showdown so you can make a more informed decision on whether to put your money into real estate or into the stock market. If you want to see more breakdowns like this, make sure to like the video. It does help the channel. Grab your caffeine, open that notes app, and let's go. Now, that said, this video is brought to you by a company that's leading in a pretty cool space right now, and one that is certainly relevant to this video, so I want to take a moment to tell you about their story. So that company is Upexi Inc., which is a publicly traded company on the NASDAQ index under UPXI. And Upexi has become the largest Solana digital asset treasury company. That means they strategically acquire, hold, and manage Solana holdings. And now, as a quick detour, if you're unfamiliar with Solana is one of the world's leading blockchains. And a blockchain is kind of like the building blocks for all kinds of decentralized applications and tokens. And I think the analogy there is kind of like WordPress for websites or Chrome for the internet. Now, the asset or the token Solana itself has scaled to over a massive $100 billion market cap with over 23 million weekly active users and over 3 billion transactions per month. And that in mind, Upexi drives shareholder value in 3 ways. So first is capital issuance. So they can raise funds like equity when it's beneficial and then use those funds to buy Solana when it's smart to do so. And then second, they then stake those Solana tokens. And if you're not familiar with staking, it's kind of like dividends on a stock or getting paid to own a bond. So they earn about 7 to 8% a year with staking, and currently that equates to about $75,000 created per day. And then third, they buy locked SOL at below market prices so they can secure built-in gains once those tokens are unlocked. So that's how they drive value for shareholders. And overall, Upexi is essentially aiming to be a public market vehicle for Solana in the same way that MicroStrategy is a public market vehicle for Bitcoin. And so far, Upexi has accumulated about 2 million Solana tokens worth about $400 million with an unrealized gain of about 72 million. And their investor returns since their April 2025 private placement is about 96%. So overall, they have an experienced team. They're looking to acquire even more Solana, and they emphasize being risk prudent, managing liquidity, and leveraging their expertise in capital markets to manage digital assets as an investment firm would, but as a public equity as opposed to a crypto fund. So again, that is Upexi Inc. or UPXI on the NASDAQ. And anyway, if you want to learn more, you can check out this link or the link in the description to read more about Upexi. And that said, let's get back to the video. So first, historically, the S&P 500 returns about 10% a year, while real estate through the Case-Shiller index returns about 4 to 5% a year. But I'm going to make the argument that that comparison is wrong. It's like comparing apples to oranges, even though just based on that, you would logically put all of your money into the stock market. And the simple example of why, at least for most people, is that if you went to put $50,000 into the stock market, you would buy $50,000 worth of stocks. But if you went to put $50,000 into real estate, you wouldn't buy $50,000 worth of real estate. Rather, that $50,000 could be 20% down on a $250,000 property. And so you're controlling an asset 5 times larger than the size of your investment. And that's leverage. And that notion of leverage is the minutia that kind of gets missed by this 5% versus 10% comparison. So let's run a 1-year simulation with $50,000. So on one hand, you take your $50,000, you buy an index fund, and that index fund returns 10%. And then you sell it, and let's forget about taxes for a moment, and you made $5,000 on your investment. So 5,000 divided by $50,000 is your 10% return. Now on the real estate side, let's say that you use $50,000 as a 20% down payment on a $250,000 property, and the value of that property increases by just 5%. That equates to a $12,500 increase in the value of the home, and then you sell that home after a year for $262,500. You pay back the $200,000 that you owe the bank, and you're left with $62,500 in cash. Now that's a $12,500 gain off of 50 grand, which is a 25% return that year. So because you had 5 times leverage on your money, even though it only increased by half as much of stocks, you actually made more than double the return versus the stock market. Now that's a hyper simplified example. There's a lot that's wrong with that, but that illustrates this concept of leverage. But even then, on the real estate side of things, that 25% ignores cash flows if it's an investment property from tenants that you rent to, then equity pay downs and tax breaks. And yeah, you could go get an equal amount of margin on the stock side, but the whole financial ecosystem is developed to support people who buy homes and not people who go gamble $250,000 of borrowed money in the stock market. Okay, but what about the other side of it? There's these phantom costs that are embedded into that return on the real estate side of things. And that cost is work, right? Buying a home, buying an investment property, renting it out, fixing it up, that's not passive at all. That is a part-time job. And also maintenance is on average going to be 1% per year of the value of the house, so about $2,500 a year off of a $250,000 home. There's also much bigger CapEx expenses like a new roof once every 8 years. And then also if it is an investment property, there are going to be vacancies. If it's not, you won't have any cash flow from tenants. And of course, you might just be priced out of the market. You can go buy a stock for $10. You can't buy a home for $10. And finally, transaction costs. If you wanted to buy or sell your home, you're paying 15, 20 grand just to sell the home to an agent and to fees. So you can argue that the real superpower of stocks as an investment vehicle is that they are completely passive and liquid. And yeah, you have to research stocks and keep up to date with the companies, but you could also just buy an index fund and literally never think about it. And you can sell that in 30 seconds completely for free. Also, diversification is a lot easier. The problem with leverage is that if that goes south, if you buy a home or an investment property in the wrong area, then you're kind of screwed. Well, if you buy the S&P, then you're just insured, you're hedged against that risk. Okay, and so this brings us back to that apples versus oranges point. The way to think about stocks versus real estate is not the return on one side versus the other. Rather, it is the active versus passive nature of the investment profile that you want. If you are willing to trade time and work for more of a return or building your own edge in the market, then real estate might be a great option for you. Meanwhile, if you want to be more passive and hands-off about your investments, then you can just buy stocks and set it and forget it. And if you do choose the real estate side of things, you do have to be good. There's more risk if you put time and effort and money into that and you just make some bad calls. But the same does apply if you start day trading meme stocks. So there's risk across the board. So a lot of this as well comes back to, well, how much risk and therefore a return are you pursuing across any investment market that you enter? So that's how I view stocks versus real estate. If you agree or disagree, drop a comment, let me know. And that said, I'll see you all in the next one.